All right. Well, good evening and welcome to this evening's special Ralph Miliband event on the global financial crisis revisited. Revisited because the three of us were here on the very dramatic days of October, and to be precise, on the 20th of October, 2008, where Martin and Will were kind enough to join me in a discussion of the global financial crisis at that very, very pressing moment. They were generous to come on the 20th of October 2008, and they're even more generous to come again to revisit it, to say something about where we are now, what the institutional issues are, what the future structures of capitalism may be like, what the implications are globally and perhaps particularly also for the UK. So let me just start by introducing them, although they need very little introduction. Let me then say something about what was said last time as a backdrop for this evening. I think it would be useful if I did that. And then I will open up with a series of questions. We'll do that for about 50 minutes or so, and then the floor will, of course, be yours. Well, first of all, welcome to you all again, and it's so nice to see so many people here during this term, when it's an exam term, when numbers can drop off quite sharply. So I hope this is productive, not just for this evening, but for those of you sitting exams, for your actual papers in a few days' time. Let me just say, as I say, about Will, of course. You both know Will Hutton and Martin Wolf, no doubt, very well. They are both outstanding journalists, both outstanding economic commentators with very long, distinguished histories. On top of that, Will, of course, is the chief executive of the Work Foundation and an LSE governor. He's also visiting the center that Mary Calder and I run, the Center for Global Governance, and he's currently a distinguished fellow here at the LSE as well. He has written many best-selling books, The State We're In, The World We're In, and The Writing on the Wall, about the challenges, above all, that China faces in its competition with the USA and with Europe, and the significance of that global competition for models of industrial and political development. Martin Wolf is associate editor, of course, and chief economics commentator at the Financial Times, an honorary graduate PhD of the LSE. His latest book is Fixing Global Finance. It could not be more relevant. And his columns, both columns of both these gentlemen, are read across the world on a regular basis. And I myself have learned a great deal from both of them over a very long period of time. What they said last time on the 20th of October goes something like this. What I've looked for in summarizing their views is commonalities of emphasis, although there will be some differences of recommendation. And before I go on, I want to thank my PhD student, Hans Trees, wherever he is, for going through the transcripts to cull some of these points, which I think are a very useful backdrop. So I asked them what was distinctive about the global financial crisis as it was developing on the 20th of October. One, the current global financial crisis is the most severe crisis of the core, it was agreed. That is, of the world's most advanced financial economies since World War II. Two, its spillover effects, they argued, have been felt across the world, will continue to be felt across the world, not just across the world's stock markets, but will profoundly spill over into a deep crisis of the real economy. Three, a clear distinctive feature of the crisis was, they suggested, the sheer scale of, in inverted commas, financialization. That is, not only the impact of the growing size of the global financial system versus the real economy, but also the impact of new kinds of financial markets and new kinds of instruments like derivatives. One consequence of this, they suggested, was the breakdown of the traditional banking model, which allowed in turn for the mushrooming of securitization. The enormous volume of financial activity, the size of remuneration packages have become unprecedented, with serious implications. Four, they pointed to two extreme mismatches or structural difficulties, if not contradictions, that were characteristic of the crisis to that point. On a domestic level, the size of countries' financial sectors, such as Iceland, Ireland, Luxembourg, one might say Scotland, but other countries besides, vis-à-vis the potential public financial support for them, i.e. the constant risk that the public purse threatens to be overrun by the scale of the crises and the debts incurred. And secondly, at the global level, the severe imbalance between Asia's forex savings and reserves on the one side and the sheer scale of US debt on the other. 5. In this context, the argument was made that the challenges that present themselves in today's globalized financial markets pose a particular challenge to the IFIs, the international financial institutions, particularly the IMF, which have effectively been overrun. The IMF's role is diminished as it is neither the structural power over creditor countries, particularly the US, nor adequate financial firepower. Thus, there is little or no external support available to core countries since the IMF's resources are too limited and countries outside the core are financially too weak. They suggested, finally, that the crisis is not yet comparable to the Great Depression, and Martin Wolf suggested at the time that the banking crisis was still at that point relatively cheap because authorities reacted relatively promptly in contrast to the crises in Japan and Scandinavia and provided early liquidity, bailouts, and cooperated internationally. So just to go on just for a second, they said things have been learned from past crises which were operative in the response to the global financial crisis as it was unfolding. The Great Depression, the Scandinavian and the Japanese crisis taught governments to act quickly, cooperate internationally, bail out struggling financial institutions, and if necessary, provide liquidity to markets. This, they suggested, was preventing a domino effect, in other words, preventing the actual, blocking the actual bankruptcy of the banking system, although they were, in a sense, de facto bankrupt, they weren't yet de jure bankrupt, and halting the domino effect as it was developing. Secondly, they suggested that important lessons had been learned about the importance of establishing bad banks or bad insurers, as was learned from the case of the S&L crisis, the Lloyd's of London crisis, and these were valuable lessons to bear in mind going forward. And finally, they said, nearly everyone will bear in mind the risks of social unrest and political disturbance that is possible in times of severe economic dislocation, the dangers of the rise of nationalism, the dangers of the rise of protectionism, the dangers of the intensification of geopolitical conflict. Therefore, all the more reason to act quickly, urgently, and decisively to diffuse the costs and spread the risks. What did they recommend? They recommended, and this is my final set of points, they recommended we need to undo, correct very lax monetary policies, which has made too much cheap money available for too long. We need to improve global financial regulation, I should say, prohibit banks from running offshore balance sheet vehicles, prevent the buildup of unsustainable levels of securitized assets, and understand that the risks that inadequately capitalized financial institutions pose to the financial system got out of hand, and so on. And so on. A series of highly precise sets of analysis with a series of precise sets of recommendations. I'm going to now pick up them on some of these points and start with Martin. Well, let me just first ask you guys, do you think that was a reasonable summary of, as far as you can remember, the discussion on the 20th of October? If not, blame him.
Very good.
Adequate starting point.
Yes, yes, I think it was more than adequate starting point. I'm sure that when we said that monetary policy should be tighter, I think we were talking about structural conditions rather than suggesting that monetary policy should have been tightened in October.
Indeed.
That would have been
that would
have been fairly mad, but otherwise
Indeed.
I think you managed to make it remarkably coherent.
Thank you, Hans. Okay, moving on. Then let me just start with the first question to Martin Wolf, because one of the things he said at the time, in fact, you stressed that the credit crunch at that point still was, in terms of banking crisis, a relatively cheap crisis. That is to say, the costs of the downside were not going to be as great as some banking crises have been. And I wonder whether you still agree with this. And in this context, do you believe that following the release of the US Treasury stress tests, which for the benefit of the audience showed that the further 75 billion of equity was still needed to top up the top US banks, that we're coming to the end of capital injections or not?
But to take the two questions separately, I imagine, though it's difficult to remember perfectly, that what I was referring to was the direct fiscal cost of bailing out the banking system as such. And there are the following points worth mentioning. At this stage, we don't know what they will be, and partly because we don't know what happens to the banks, and even more important because a number of governments, including, not least, to put it mildly, quite particularly our own, have made very large contingent, have accepted very large contingent claims against the banking system through the guarantees that they have provided. The US government has done the same. Indeed, most governments have done that. And how much that will end up costing really does depend on what happens to the quality of assets over the next many, many years. And we can't know that yet. On the basis of what we've seen so far, the most recent estimates by the IMF are suggesting that the highest cost, this could well be wrong, if I remember correctly, it's for the United States, it's about 12% of GDP.
6 to 13 was the figure, 6 to the range.
Yes, so 12 to 13 at the peak.
Yeah.
Now, that is, that's a pretty high cost, but as I'm sure I pointed out, in a number of emerging market financial crises, the fiscal cost of bailing out the banks went to as high as 55% of GDP. If that turned out to be right, and is the most extreme, most of the other countries have lower. I think for the UK it was about 9, wasn't it? I would stand by the statement that the direct fiscal costs don't look extraordinary by the standards of financial crises. I would, however, add one very important qualification, which I've repeated many times. The big fiscal cost in all the other crises has generally been simply the impact on the fiscal position of huge recessions. And it is pretty clear now that the impact on the fiscal position of a number of countries, including the UK, of the recessions associated with this crisis are very large and very severe, and certainly larger than I then believed. So the overall impact on public debt of this crisis will clearly fall within the now very famous measure estimates of Carmen Reinhardt and Ken Rogoff, which suggested, roughly speaking, that it is normal in a crisis like this for public sector debt to double. Given the starting point, that's roughly it. And that seems to me now a pretty plausible estimate for all the major countries. To put it precisely, they said, I think it goes up to about 80 percentage points.
Let me see if I can add to what Martin has said. And I think that first of all, I mean, the scale of intervention, and I like to think of it in these terms, and others think in different ways, but there's £400 billion worth of liquidity, well, it's 375 billion of special liquidity measures and quantitative easing and liquidity revision. And that's amazing in itself. Then there's £250 billion worth of guarantees into bank market. There's £585 billion of asset protection, and there's the best part of 40 billion has gone into the base of the banking system. Now, that's cumulatively 1.3 trillion pounds. Now, I mean, some of that is liquidity and is close to risk-free and will come back eventually. Although there is a problem in that by 2007, around 700 billion of the 2.5 trillion of sustained liabilities in the United Kingdom were provided by foreign banks, and they have fled the field. And part of this liquidity provision, I like to think of it, I'm used to hear what Martin says, it's kind of the Bank of England stepping in necessarily to make good that gap. And that may take 5 years, even longer, before the Bank of England can kind of step back, before money GDP rises sufficiently and savings rise sufficiently for UK savers and UK financial institutions and some returning foreign institutions to kind of make good. So that's, you know, there's an opportunity cost in that. Then there's the 585, 320 billion of asset protection to Royal Bank of Scotland and 260 billion to Lloyds Group, or in particular HBOS. How much of that will be lost forever? The answer is, as Martin says, nobody knows. The IMF have a range of 6 to 13% of GDP, and they put the number out before the budget and said it was 100 to 200 billion. and almost all of that was in that asset protection, or kind of the British version of a bad bank. How much of that will go? Well, there's very, very, and this has not been picked up enough, and I think it's the next phase for Martin and me really probably to do this, but all the incentives are for banks to actually take the first 10% of the loss and then pass the balance of the loss on to the taxpayer. And this is already taking place in both loan portfolios, particularly HBOSs. And Lloyd's made that clear last week when they gave their report and accounts. I actually think that their most recent figures, not the report and accounts, I think that anything up to half that HBOS that's 130 billion pounds will never come back. And I think that it could be a goodly quarter of the RBS. We could be talking about 200 billion. That will be partially compensated if we ever manage to sell the equity in the two banks we now hold a stake in. The British taxpayer has 70% of RBS and 46% of Lloyd's Group. And those shares, if they were to double or treble in the next 3 or 4 years, were from the the striking price at which the government took the stake, the gain on that will partly compensate for the loss on the asset protection scheme. But my hunch is that we could be looking at the eventual loss could be of the order of £100 billion. That the IMF's lower range, the lower end of its range, is the likely outcome, and that assumes quite a lot of good things happening. By the way, that is, and then the liquidity provision having to carry on. By any standards, that is an astonishing sum of money, because over and above that, you've got the depth of the recession and the slow climb back. I mean, the National Institute, in their economic review, which I thought was quite good. I mean, they basically say, look, this recession began in March 2008, and they don't expect 2008 levels of output to be recovered until the first quarter of 2012. And that's probably about right. And then you have to say, well, what's the trend growth rate going to be beyond that? I don't think it's going to be 2.75%. I think it's going to be nearer 2 than 2.75%. We have a balance sheet constrained UK economy, and that's all knock-on consequences of this extraordinary credit crunch. So however you describe it, the costs are amazingly severe financially. Before we start talking about unemployment, repossessions, business models that are completely bust, foregone opportunity, I mean, really, this is a catastrophe, and needs to be understood in those terms.
Do you want to come back on that?
Yes, I think the really important point we agree on is the really big costs are the costs of the economy as a whole, and among other things from that to the public finances. To give one indication, let's suppose the cost of bailing out the banks was indeed 9% of GDP. Well, that's less than the government's borrowing requirement in 1 year, just as a result of the whole range of things associated with the recession, the slump. And so the really big fiscal effects, quite apart from all the social and other effects that Will suggested, are the recession impact. The only other point I would make is, I wrote about this once, I'm very, very unhappy with the way we've gone about guaranteeing our banking system. Everybody's got a slightly different system. But the problem we've got, it seems to me, with the incentive problem is basically these banks are still being run independently. Obviously the government is the largest shareholder. It's not clear how far it's interfering in the management of it. And once the bank gets beyond its tranche of losses, the losses are all being borne by the taxpayer. It has, at that stage, next to no incentive to manage its losses properly.
Well, it's not even doing it.
This strikes me as an extremely bad situation. A lot of economists have been recommending this guarantee type of system, this insurance sort of system. They've used it elsewhere, but it's an approach that worries me a great deal. It's a very non-transparent way, essentially off budget, of giving basically a blank check to the institution. And my own view is that once essentially the taxpayer is bearing all the risks, the taxpayer the representatives of the taxpayer, the government, should have been running it in their own interest. But
my understanding, Mark, is it's that your concern is absolutely happening. I mean, both Royal Bank of Scotland and Lloyds Group have put those assets into the teams that do work and restructuring of companies that are in trouble to whom they've lent are not being allowed near those asset portfolios. They're being managed a different kind of way. They are being, and the companies which are being lent to are already being put in administration rather than having workouts or restructuring. That's exactly the incentives that you're fearful of.
I want to come back to the social implications of this later. I mean, not just the employment, but the inequality implications, the implications for poverty and so on. But let's just move the discussion for a moment away from the developed world, where most of the attention has been focused certainly in the media in Europe. The impact of the crisis is, as you know, has clearly spilled over substantially into the real economy. There's been an extraordinary fall in global trade. This has impacted, of course, not just on China, but on some of the world's very poorest countries. Can you all hear an echo?
So they're irritating, isn't it?
Should we just try and turn off these mics? Let's do an experiment. Now, you can still hear us, right?
Can you hear us?
Is everybody all off? Let's carry on. The World Bank has recently warned that the implications of all this for the world's poorest countries are absolutely devastating. And yet this is not part of the general public discussion, at least it's quite marginal. Can we just spend a moment just thinking about the impact of trade for the finances of some of the world's poorest countries and what you think this will be? Can you hear?
No.
We'll speak a bit louder. Okay, thank you for telling us. Okay.
I think my mic is still on, actually.
Okay, we'll keep yours on.
Actually incapable of turning anything off.
We'll keep yours on.
I'll keep mine on. The sound has gone, okay. Was that a question addressed to me?
You start, Will.
Well, I mean, the straight answer is that this is a, as it's in many cases, this is a calamity that starts off in the first world ends up by being a kind of triple calamity in the less developed world. It's not just a story of it's a story of commodity prices. It's a story of capital markets closing down, and many of these countries in Latin America and Africa in particular, the Islamic world, are facing there is no finance, and you are seeing really very substantial falls in GDP. I mean, the story in Eastern Europe is well known and of enormous concern. I mean, they have many, Hungary has taken out a lot of individuals and businesses have taken out euro debt because it was cheaper interest than taking it on Hungarian debt, persuading Hungary joining the euro. That's turned out to be a kind of absolutely first-order disaster because as their own currency has depreciated, their capacity to service that debt has become much weaker. I think there is a very, very substantial problem in Asia. I think that Asia constructed its economic model essentially being kind of high saving and high exporting to the United States. The Asians will tell us that the reason for global imbalances is because of America's insatiable appetite for kind of imports and the cavalier way the Americans ran their economy. I mean, actually, the Asians needed the Americans to do that, and had the Americans not acted as lender or buyer of last resort, I should say, as they themselves describe it now, Tim Guyton now describes it in these terms, the growth of Asian exports to the United States and their growth rates would not have been so substantial. There is now a very significant kind of, I think, kind of unfolding crisis in Asia as export volumes really fold. You can see it in China in particular. In 2007, China's export volumes were up 25% on 2006, and the growth rate fell to 7 or 8% in 2008. The World Bank is forecasting minus 6.5% in 2009, and I personally think that figure could be too high. And China faces a really very substantial, long overdue rebalancing of its economy. It's going to have to lower its savings rate, increase its domestic consumption, and rebalance its economy away from reliance on exports to the United States and Western Europe. But the Chinese don't want to do that.
their industrial structure is predicated upon the capacity to export to American and to a lesser extent Asian and European markets, and making that change is extraordinarily difficult and time-consuming. If they thought they could do it against a background of rising world trade over a period of years, they've got to do it in a year or two or three. The size of the Chinese reflation, which everyone remarks on, I think is the battle between the Dengist kind of market-reforming liberals in China and the authoritarian state capitalists has been won emphatically by the authoritarians. The character of that reflation is all about supporting state and enterprise and infrastructure spending, and astonishingly, about 3/4 of the financing of the reflationary package falls to Chinese banks. I think that Chinese banks, Ernst & Young, back in 2006, said that there were between $600 and $900 billion of non-performing loans to state enterprise in 2006. That figure has doubled by the end of 2009. I think the figure will be close to $2 trillion. In other words, the Chinese banking system has got its own subprime crisis waiting to unfold, even as it tries to make this adjustment away from export-led growth. So you have China potentially in considerable trouble. You have other Asian countries, I think, in similar kind of suffering similar problems to China, not so acute because they were less reliant on exports than China and had lower savings rates. You have Africa suffering really adverse terms of trade and kind of almost cessation of private capital flows. The world economic periphery is in profound trouble as we talk.
Can you comment on that, but also perhaps bring in the role of the IMF and the World Bank, and particularly the G20's efforts to substantially increase the funds available to the IMF, to commit themselves in principle to the reform of IMF, and do you think this is sufficient to keep the world's poorest countries stable?
Well, first of all, this is very complicated, and I don't want to go over the same ground as well, so I'll try and look at other things. The G20, first of all, it should be said the G20 meetings have been rather a remarkable feature of this story, both because the outcome was certainly very different from the famous or notorious London Conference of '33. It indicated a somewhat higher level of cooperation, which is, of course, not very difficult since that failed completely. But in addition, this was I think this was the passing of the baton. This was a moment of the highest possible crisis at which the decision was made that the only reasonable body to discuss the policy and geopolitical and geoeconomic implications was a grouping that included all the major developing countries. Some of us think it's too big, and include some countries that perhaps shouldn't be there. I'm not going to list them. The UK, for example. But it includes clearly all the important countries. That's very important. And the agenda was very broad, and the communique is actually, by the standards of international communique, particularly the last one, not at all bad in the range of things it covers.
So it's good.
Yes, okay, not at all bad. I think that was rather remarkable, very important and significant, and possibly will lead to important things. Second, they agreed on some really important things. We will talk about regulation later, but they agreed, at least in principle, that the IMF's lendable resources will be increased, admittedly through informal processes, because getting through quota increases takes forever, from about roughly $250 billion to $750 billion, and efforts have been made to go in that direction. And there's also a decision, which I think is very important potentially, to revive the SDR, the special drawing right, and make an allocation of that too, which interestingly the Chinese government has been supporting. There's some important contributions on this from the governor of the People's Bank of China on the international monetary system. I'm very pleased with that because I think the international monetary system is a core part of this whole crisis. It's not all of it, but it's an important part. I think that will happen, at least to some degree, and that will give the IMF loanable resources to deal with crisis countries. And in case you hadn't noticed, the IMF nowadays, in terms of the famous lending conditions and And so when he's going around the world telling people to have bigger fiscal deficits, this is a very new IMF. So there is an extraordinary change, and Dominic Strauss-Kahn is an adroit politician. He understands the way the wind is blowing. So I would say it could have been much better, of course, but actually some things happened there, and that will be relevant to particularly to Central and Eastern Europe, some of the other larger countries. Now let me just talk briefly about the countries to the extent that has not been covered, and the implications. Among the more advanced emerging regions, it's clear that Eastern Europe has been the worst hit. And that has very profound implications for a sort of underlying thesis of mine. Why was it the worst hit? Well, essentially because it was the only region of relatively advanced emerging country region which continued or indeed embraced the idea of opening itself to net capital imports and ran very large current account deficits. It did so because it believed that as it was integrating into the European economic space, it would end up the countries would end up in the Eurozone. They were to some extent underpinned by the whole European project. And indeed, as Will said, as a corollary of that, many of them actually encouraged their citizens to borrow euros and Swiss francs and other such currencies. This turned out to be a pretty serious error. And they've learned the lesson that the Asians and the Latin Americans have learned in previous periods, that if you run very large current account deficits and you're hit by a financial crisis, which may have nothing to do with you, the capital will turn tail and run, and you will have an implosion of your economy. That's what happened to Asia in 97, 98, and it's what's happening to this region at the moment, with very varying effect. Not every country is in the same situation. And one of the things they're going to learn from that is probably, unless they end up in the Eurozone, is that they're going to do the same thing as other emerging countries have decided to do: accumulate reserves, run current account surpluses, and that's going to increase the big global imbalances problem, which has been a part of this whole story. But that's a very big part of it. Asia is badly affected in a completely different way by manufactured exports. There's been a staggering collapse of manufacturing and manufactured exports, because what's happened is that all the rich consumers of the world have decided that what they're going to stop doing is buying durables, which they can perfectly well postpone to some later point. And the collapse in demand for manufacturers has been simply staggering. And that's hit Asia very, very hard. It's a region that's been less reliant on capital inflows. In fact, they've pretty well insulated themselves, so that's gone through trade. Latin America's been a bit in the middle of this, but most of the Latin American countries look as though they're going to survive this, at least by comparison with other financial crises, relatively well. Now, on the really poor developing countries, I haven't looked through by any means all countries, but the strong impression I get is of extraordinary variability in the impact. It's very striking, by the way, because I've been looking at this today, that the IMF's own forecasts for Africa, which were just produced a few weeks ago, are very optimistic. They expect sub-Saharan Africa to grow quite strongly this year. This may turn out to be utterly wrong. They also believe that capital will continue to flow into that region net, quite different from Eastern Europe, where it's expected to flood out. Whether that will turn out to be right, I don't know. But it is important to make some analytical distinctions in terms of countries which are net exporters of commodities, particularly the commodities whose prices have collapsed, foodstuffs particular, and metals and oil, are obviously very badly affected by this crisis. But it's important to remember there are quite a lot of emerging countries, very poor emerging countries, which are net importers of this stuff. They're going to be benefited to some degree by this. And of course, a lot of the very poorest countries are the countries that are least integrated into the world system. They're not going to be affected. I suspect that the worst affected poor people, but this is a suspicion, I don't know, will turn out to be the vast number of poor people in countries that are actually in the middle income that are moving quite fast. For instance, people in India and China. It is important to remember that India still contains within it more desperately poor people than the whole of sub-Saharan Africa on the Indians' own statistics. And if there's a significant decline in growth, and the same is going to happen in China, particularly given the structure of growth, which is going very capital intensive, this is not a way they're going to generate any jobs. If that happens, then actually it may well turn out, when we know better, that the poorest of the world who are really going to be hard hit will not be people living in sub-Saharan Africa, but actually very poor people living in these very big countries which still have incredibly large numbers of poor people in it. This said, it's clear that one of the priorities should have been to use some part of this simply staggering amount of money we're throwing at the financial crisis to cushion poor countries against the shock, and this has happened, unfortunately, to a very limited degree.
Okay, I want to ask you, both of you, 3 more questions before we open up to the audience. We've got about 20 minutes for those.
So
three
we'll be more
questions.
disciplined.
So I need you just to be a bit shorter each of them, because I'd like to get the background out before the audience asks some more particular questions. Let me just ask you a little bit about where we are with changes to regulation, nationally, regionally, and globally. Last time you were here, you both spoke of the need for some kind of global financial regulator. Global financial markets need some kind of global financial oversight. Okay, that's one of the challenges, but the challenge is clearly multi-level, national, regional, and global. Where do you think that we are moving nationally and regionally and globally in the right direction? In other words, do you think once we're out of this in the years to come, we will have a new regulatory regime that will significantly embody the lessons that we need to learn now? Martin, let's start with you on that.
Okay. Well, I think my view of where we've got to is, well, separates into structure and principles. We're not going to have a global regulator of the financial system. I'm not very surprised we're not going to have a global regulator. I hope for one, but I never thought we would agree on one. The US has made it in particular absolutely clear that it cannot and will not delegate responsibility for regulating its most important financial institutions to any external body. And I think that will be the general conclusion. But we're not going to have a global regulatory regimes. So the more interesting question then is, will there be common principles implemented nationally, or in the case of the European Union, on the European-wide scale, in a consistent manner, which themselves make sense? And the answer to that, I think, is only to a quite limited extent. And here there are some really important issues, absolutely fundamental conceptual issues. First, it seems to me quite clear that there has been, as it were, a tacit decision, it's exactly what I've expected, not to make fundamental structural changes to what the financial system is, namely, essentially to accept the financial system as it is and to try to regulate it better, which means a number of quite detailed rules in terms of the way capital ratios work in banking systems, in the way derivatives markets work, all these sorts of areas, but essentially accepting, indeed embracing, as we come out of this crisis, as the dominant players in the whole system, huge, even bigger, even more too big to fail, multi-product, multi-service financial institutions operating in every market in every country in the world as the dominant players in the system. Derivatives markets working more or less as they did before. They may move some of it onto exchanges. So in terms of the structure of the financial system, I think we're going to end up very disappointingly with remarkably little real change. What we can expect, I think, is at least a period of somewhat tighter regulation. The Basel rules will all change on banking because they were obviously absurd. There's going to obviously be a move to so-called macro-prudential regulation. There will be more systemic oversight at the national level, and there will be an attempt to coordinate that internationally. There is one other huge conceptual issue that is not going to be addressed, it seems to me, which is how we combine a global financial system with national fiscal responsibility. We have been reminded here, we didn't confront this issue before, but we have been reminded, as Will has reminded us, of the immense cost of global banks that screwed up. Now, the immense cost to national taxpayers. Now, it's pretty difficult, it seems to me, to sustain a situation in the long run. This is something that people don't really want to address. Sustain a situation in which national taxpayers underpin the balance sheets of institutions that do nearly all their activity offshore. That's particularly significant for the UK. Every time I think of what Barclays is doing in investment banking, I get very, very nervous, because that's my money. It's your money too, I would just say. And I think that's another issue we've not addressed. So my feeling at the moment, I know it's a lengthy answer, is that we should be pretty worried. We're going to have a period when the financial system will be quite cautious. It will last a month or two, maybe even, it might even, I'm joking, it might even last a few years. But I am really worried, for this and other reasons we'll come to, that we are laying the ground for the next crisis.
Will?
I haven't got much to, I think it's very disappointing, I have to say. I think the, can you hear me? Yeah, I think it's very disappointing, and there's going to be tougher rules on bank capital. You can see that, but you run through a checklist. I mean, you look at bank bonuses and bank pay. I mean, really, there's some grand talk by the G20, but I don't expect anything substantive on that at all. Even the proposals by the European Commission on hedge funds and which were aggressively resisted by the London hedge fund community on the grounds that they didn't cause the crisis, and you could see the lineup already of where we were in the run of 2007. As a matter of fact, no account of the crisis and the seizure of the interbank markets is complete without the role of hedge funds. It was, as a matter of fact, the collapse of the two Bernstein's hedge funds in end July of 2007 that led to, $10 billion of losses to investors, because they were just closed to investors. That was what caused the interbank markets to freeze in New York, and when Bank Paribas had their 3 closing in Europe. And because everyone thought, my God, those highly leveraged hedge funds having, and there's going to be huge losses in interbank markets. Will the counterparty to whom I've lent the money be able to get their money back from their hedge fund? And that was what actually caused interbank markets, above anything else, to freeze. That's what caused the rates to rise. And that's what actually got so many of the banks who relied upon the interbank market as integral to their business model into trouble, notably in Britain, Northern Rock, but also in the States, all the investment banks. So the story that this sort of hedge fund story, we don't need to regulate it because we weren't part of the story. The story was big banks are too big to fail and building societies in Britain is just wrong. But already, you can see them making that argument with no challenge, really. No effective challenge. I mean, Martin will try, and I try, but no substantive challenge in the House of Commons, no substantive challenge from regulators that I've read. And so it goes on. I mean, I think there's an extraordinarily, I personally think that the most of the value added in so-called investment banking is close to zero, and arguably negative. I mean, I don't understand the argument that all this talent mustn't leave London because we must carry on with investment banking. So we have all these bits and deals, most of which end up losing shareholder value, or they can manipulate the debt markets with the result that we've seen. Why do we need this industry? And if they want to go and play, they should do it with their own capital and without access to our guaranteed deposits. I mean, it really is. And yet, Sir Ben Bischoff, former chief executive of Citigroup, was charged by Alistair Darling to produce a paper on UK international financial services, which they co-chaired, actually. The list of people on it is a list of all the city dignitaries. It came out last week. Do go on the Treasury website and read it tonight. You will find it starts off quite well with a kind of orthodox account of the crisis, which is, I mean, kindly, I think, says it's all systemic and about global imbalances. Not much to do with bankers. And then it says, of course, we need the minimum regulation, but of course we need some regulation to regain trust, which we understand we have lost. So only to regain trust we need some regulation. But then substantially, we must leave the system as is. We must have, and Paul Minor said, we must have these giant banks. We mustn't allow banking to go back to cottage industries. I mean, cottage firms. I mean, why not have 10, 20, 30 British banks? We are, to my money, you know, there are 9,000 United States banks for an economy which is, about 8 times our size. Pro rata, Britain could have 1,000 banks. I'm not advocating that, but you know, we certainly could have more than 4. And I don't actually, and I plus nationwide and a few building societies. I mean, I don't see what the arguments of scale are in banking. I think a plurality of runners and riders. Certainly, I'd like to see, and to name a name, I mean, variable rate mortgages from Barclays Bank in particular are 4.99%, funding them into bank markets at 0.5. That's 449 basis points for those of you. Those are margins, they are incredible gross margins, incredible. But there's no competitive challenge because the other 3 banks are not going to challenge them. So, you know, we need, and if you, the only politician who's tried very tentatively, and whether he'll stand by when in office, when elected next year, is an open question, is George Osborne, who has actually had the temerity to say that actually, you know, the nationalised banks, or the part nationalised banks, should be broken up. And we shouldn't have banks that are too big to fail. And I find myself, unexpectedly, wholeheartedly agreeing with the Conservative politician. And I find the line of the British government on this breathtaking. And we have not taken the opportunity to restructure the banking system at all.
Okay, Will, let me just let's keep with that theme for a minute.
Sorry, I didn't.
No, because I think what you said is very important, and you say it in a way I think that is very significant. But let me just ask you something slightly more theoretically now. Is that Martin wrote in a wonderful article in the Financial Times recently summarizing the nature of the crisis. He said something like, well, referring to Dorothy and the Yellow Brick Road, saying that the financial crisis had sort of thrown the house up in the air and it was sort of spinning down, and you open the window and the only thing we can say is we're no longer in Kansas. That is to say, we don't quite know where we are post the crisis. In other words, that many shibboleths have fallen to the ground, the isms of liberal financial market ideologies have fallen to the ground, liberal economics has come in for a hell of a hammering, and so on and so forth, that the standard liberal model has been profoundly questioned. And yet, what you are both saying this evening is actually the system is intact, there are going to be some regulatory changes, but actually the seeds of its further development and instability are already set into the future. And actually, it's not that the house has come down and we say we're no longer in Kansas. We know exactly where we are. True or false?
Correct. Well, this gets back to the really big issues of how we come out of this crisis. I think that this is really tentative because we're right in the middle of this. We don't know how this is going to go. It seems to me that the scale of the support that has been given to the financial system and to the economy via fiscal policy, which is completely unprecedented in peacetime. We've never run fiscal deficits like this anywhere in major countries in peacetime. Monetary policy that we're seeing today is completely unprecedented. So basically everything has been thrown at. And those unbelievable margins are, of course, exactly what government wants. That's how the money is transferred to the banking system. That's why it's so nice to be a bank. They can lend, they can borrow from the central bank. You can't. And the central bank can create this stuff without limit. Now, the very fact that we are having this extraordinary policy response, and there is now much discussion that the economy itself might turn around in the course of this year, certainly early next year, which doesn't seem to me implausible given the scale of the stimulus, obviously reduces the pressure for fundamental reform. That's the first point. The more successful you are at macroeconomics, the less pressure there is for micro change. This is one of those great dilemmas, and I've accepted that, because I don't think that in order to get a reform of the financial system, I want to live through the Great Depression. And this is, and I mean, by and large, big reforms follow big disasters. And the more successful they are, this is a disaster, but the more successful they're making it a manageable disaster, the less big reform there'll be. That's the first point. The second point is, I clearly, but there's an important qualifier. I'll do just 2 more points. Second point, one really cannot underestimate the effectiveness of the financial sector as a lobbyist. It is in a class of its own. I don't need to say any more on that because it just happens to be true. And in the UK, of course, it has become, I think you're going to come to that, the sort of the dominant industry. So it's, but I'm not just talking about the UK, it's true elsewhere. I won't go into, the third point, however, and I would insist on this, is that it does seem to me that intellectually, what I say I would still stick by. The fundamental ideas that drove economists and policymakers in the direction of liberalization of the financial system and the way they did it over the last, let's say, 10, 15 years, maybe 20, they have been largely discredited, and economists are very well, or many economists are very well aware of that. Economics is now at war with itself, which I think is very interesting process. If, as I believe will be the case, and we can discuss this further, that this will not be a real resolution of the problem because so many of the deep underlying problems are still there, not least the simply monstrous debt and credit overhangs in our economies, which we can't just wish away because they're there. Therefore I expect the financial sector to show new problems in the future. I suspect we are going to get to a different world more slowly and more painfully, but I would be very surprised if in the end we don't end up in a somewhat different world. But it is the case that, at the moment at least, the whole thrust of policy is to get through it by throwing the kitchen sink at it macroeconomically, as it were, and let the microeconomics essentially fall back the way where they started.
Exactly.
Go on, Will.
Well, I very much agree with that. I mean, I mean, the scale of the support I described at the beginning, I mean, 1.3 trillion pounds plus, you know, of which a component is this budget deficit of 175 billion, is keeping the system going, actually. And you know, the capital markets divisions of our bigger banks are really rather happy. I mean, Barcap are doing terribly well. And Bob Diamond was on Bloomberg recently saying the banks are back, together with the 20, 30, 40 million pound bonuses. And it is a, I mean, and I've really not got much to add to Martin's point about the effectiveness of the lobby. I mean, again, look at the Bischoff report to look at that. I mean, if you were going to revise, if you're going to think about, you know, the future of UK international financial services, it might have been nice to have some voices on that group of men and women, and there were mainly men, by the way, who weren't international bankers, who might actually have said, you know, like, for instance, challenge and grit into that decision-making and that deliberation, but there weren't. And if you ask them to write a report about how they think their future is going to be, you can hardly be surprised at what they've come up with. And will things move intellectually in a different way? I think they they have to, because the models that officials, regulators, academics, intellectuals, commentators have used to describe the world have probably failed. And you can't, we are sentient human beings, we're not in the business, most of us, of trying to get things wrong, we want to try and get things right. And if the model that you're carrying in your head doesn't work, you try to adapt it. And I think that adaptation is in the best American universities already beginning. Trouble is, in Britain, the capacity to kind of declare intellectual independence, certainly economics, and some other social scientific disciplines, is quite difficult. I mean, it's their textbooks, it's, you want to get published in their journals, they peer review you, so you better buy into that stuff if you want to actually get a job after the LSE at Stanford or Princeton or somewhere. And that's kind of, there's a lot of consensus within the profession for actually towing the line. But actually, if that line leads to such kind of bad predictions of what actually happens in the real world, I think change is likely to take place. I do think that there will be more recognition that that institutions and the structured institutions and incentive institutions matter a lot. So I think there'll be the question of corporate governance will open up. I think how companies are owned will open up. I think there'll be a lot of interest in monetary and financial theory, which has been quite a closed book. I mean, it's been almost no one takes an interest in it. I mean, I think Keynesians will start accepting the fact that it's not just a case of particular market failure. Keynesianism is a way of looking at the world and, hey guys, it works. And I think the kind of policies we will see will be much more in the Galbraithian, kind of New Keynesian economic philosophy than actually the kind of inverted commas market fundamentals. I'm not particularly happy with the market fundamentals tag, but everyone understands what I mean by that. But it's going to be slow. It's going to be slow because so many people are bought into the current way of thinking. I mean, bankers certainly are, academics certainly are, regulators certainly are, business school courses certainly are, and actually a lot of our institutions are predicated upon a view of how the world should operate, which just isn't right. And so moving them is not going to happen like that. It will be a process that takes some years.
Now, I want to ask one more question, but I don't want to shortchange you all. So all I'm going to do is put my last question on the table for later, and maybe you can come back to it if you think it's relevant. So we're going to take questions in clusters of 4 or 5, if that's all right, to get as many of you the chance to raise issues. Keep your questions fairly short, that would be great. We've only got one mic down here and one at the top, is that right? Just sorry? And one down here? No down here, so you guys will have to shout, and you might have to shout too, we might forget the mics. But let me just put my question on the table for later, then I'll come back to you. The question is, particularly I'm interested in the implications of all this for the UK. The UK has undergone a period of deindustrialization over the last 3 to 4 decades. There's been a massive decline in the relevance of the manufacturing sector. It's an economy that depends increasingly on services and the financial industry. The city is now in disarray. What is the impact of all of this on the UK in particular? We seem actually caught, as it were, in a very vulnerable position going forward. And I wonder, I'd like you to comment upon that at some point in the proceedings. Yes, the lady in the middle, please. Yes, you have to speak up because there's no mic down here. Shout. Louder.
It seems to me that there's a bit of a problem with this sort of focus on financial kind of misdoing. So I think one of the problems that evades some of the fundamental economic problems by focusing on the misdeeds of the bankers and so on. For example, the fundamentally or relatively unproductive Western economy and the reliance on easy credit. America, for example, is a prime example of this, where the government actually encouraged easy credit to kind of mask the unproductive economy. So I think we need to look as well at governments, not just about the kind of all-powerful finance lobby, but about, maybe think about where blame should be laid. And I think the kind of criticism of hedge funds is almost the worst of this. Think about Germany and France going on and on about hedge funds. And we know, for example, that Germany may have about 800 million kind of undeclared losses in the bank.
Billion,
thank you. Now, it suits, of course, governments.
Okay.
Criticize.
Thank you. We got it. Now I want questions to be shorter than that, please. Okay?
It was a good question.
Up there.
Thank you very much. I'm surprised when you talk about the banking lobby, you don't discuss members of the FSA. But quick question. We have the bankers blaming the politicians blaming the media, and it's all one big tripartite circle here. When are you going to look around and start blaming individual people and say, the public, the spend now, save later culture has to stop, and people have to realise, have a bit of financial education involved?
Okay, the gentleman next to you, just might as well get you both at the same time. Okay, short.
Thank you very much. It is a quick question. Based on the massive collapse in Chinese exports that you talked about, is there? I mean, I know Hillary Clinton has been to China several times in the past few months, begging them to keep servicing American debt. I was just wondering if you think they are going to continue to, and if not, what happens then?
Great. Okay. Yeah.
Thank you. Commitment on climate change. This was 10 years at best before the global financial crisis. Where are we now?
Okay. And one last one on this round.
You talked about the regulatory environment after the crisis. You're sort of talking about how they're throwing a lot of things at the crisis right now. Reminds me of the line from Lewis Carroll, if you don't know where you're going, any road will get you there. The question I have, though, is that if we're talking about the problem we had, the post-G20 environment, we looked at it and said, governments have come in and talked about spending more money, fiscal adjustment. The problem in the crisis wasn't that governments weren't spending enough money. The problem was we had too high of a debt ratio. And there's four ways out. You either have a higher savings rate, you have a lower debt to GDP by some forms of default. The third option is you have unanticipated inflation, or the fourth option you think, well, maybe we can get back onto a Ponzi scheme. Clearly option 4 is not the good one. Option 2 in terms of widespread defaults, not good for the economy. Option 1, you can't have everybody in the world saving by definition. So are we looking at an environment where we have to have some form of unanticipated inflation, or is there a way out of it without seeing that outcome?
More or less excellent, disciplined questions. Now, in order to ensure that you all have another chance to do that, at least more than once, I need you guys to be disciplined too. So, Will, go for it in your usual way, but keep it to 3 or 4 minutes.
Goodness me, 3 or 4 minutes and all of that. And there's your question about the UK economy on the table too. I think that climate change, I think that the fact that G20 managed to make so much progress, and the Chinese are indicating, along with the Americans, some movement. I'm not so pessimistic about Copenhagen as I was 4 weeks ago. So, and I think that actually there have been some lessons about the necessity for collaboration that are highly useful. On China, I think that the Chinese are holding more and more of their reserves in gold bullion and in euros and less in dollars, and that will have be the kind of interdependence between China and America is plainly going to be threatened by that. That will be what's actually happening in China is that it's trying to move away from kind of this interdependence it's had and its export dependence. It's trying to change, but it's trying to do it by holding on the state enterprises, and actually freezing the reform program in important respects. I am really profoundly concerned about what's taking place in China, and I think in the next 3 or 4 years it is quite likely that there'll be very substantial banking crisis, and that there'll be very substantial rows within the Politburo, and maybe we may even threaten a peaceable handover to the 5th generation of Communist Party leaders. That's in a sense where I think the genesis of or the locus of this crisis goes next. On points about kind of hedge funds and naming some names, I mean, it is striking, isn't it, that there's been AIG has been looked at because there's been outright fraud at AIG. There's been some hedge fund managers actually arrested in the States. And I always think the Americans take capitalism seriously enough and the chance of malfeasance serious enough to actually get in there and do some arrests. And actually, we see Bernie Madoff in his handcuffs pleading guilty. Do we really believe that there was absolutely nothing happening of similar order in the UK, in London, that we were angels and the only people who behaved badly or should actually be hauled before the courts are in the States? I think not. I certainly agree with you that financial education should be substantively improved. As for the point about hedge funds, and in the end, yup, there were the global imbalances. Yup, the regulatory environment was poor. Yes, shareholders should have insisted that the incentive structure in these banks was better. But in the end, you know, the people who generated collateralized debt obligations and grew them from zero to more than $10 trillion in less than a decade, imagining that they had abolished risk, were actually the American and British investment banks with some, you know, Kuwaitis, Icelanders, Dubliners, kind of doing a bit in their wake. And one has to say that is where the locus of the problem is. And I think they're trying to say, you know, it's broader problems, or you know, not a, you know, we shouldn't carry on blaming bankers. I think one really has to keep one's eye, you know, very firmly attached to that. And I actually, yeah, the Germans and the French are probably a bit too obsessed by hedge funds, but actually to imagine that hedge funds, I repeat myself, were not part of this story is just factually not right. They were part of the story, and actually more transparency, more system in the way their accounts are looked at by the regulators is absolutely in order, in my view.
Pass the baton to Martin.
In order to save time, because I'm going to focus on one question which actually I think was been asked in 4 different ways, which is, in a sense, how the hell do we get out of this credit overhang mess? Now, part of the question is my sense of what happened in the world economy, and it diverges a little from Will, or at least it leads to the same conclusions, is that, and this is incredibly crude, the system worked for reasons which are very deep and don't have time to explain, by having some countries, actually in this case predominantly a number of developed countries, specialize in consumption and others specialize in production. This is extremely crude. And the people who specialized in consumption, or the spend now, save later culture, did a remarkably good job of it. And the British were not the least in this. And in the process of getting lots of people to spend far more than their income, which is really what we were trying to do in response to what was going on in the world, we generated massive housing bubbles and massive credit bubbles, and that's what we live with now. And let me be quite clear, I'm not trying to blame anyone, that's what happened. Now the question is, so what now? Well, this is really very tough, and it's what worries me. It seems to me quite clear what now, what the world economy is trying to do, what we, quote unquote, in aggregate are trying to do, is to get all that working again by first getting a large part of it done through government debt, so that's what the fiscal expansions are, and another part of it, but through the incredible monetary policies going on, and what we're doing with the financial system to get the household sectors to start borrowing again, so to go back to where we were. And that's, in a sense, what everybody wants to happen. The only problem with it is there's so much of this stuff out there already. And the danger is, and it's very severe, if we succeed, we'll just generate an even bigger crisis later on. So how do we get out of it, which is the question you raised. Well, if we talk about the desirable ways of getting out of it, it seems to be pretty clear. We don't want, I don't particularly want hyperinflation. Well, some people do, but I don't. I don't want liquidation. That's what they tried in the 30s. It wasn't a good idea. So you have to grow out of it. That's essentially, your economy has to grow out of it, which means there has to be a fairly extended period in which private credit does not grow faster than the economy, but it still grows. The economy grows in the borrowing. That's really hard. There are only 2 ways you can do that. One, you have to move into a large net export position. In other words, the deficits have to be shifted, and countries like ours become surplus countries. Very, very difficult. And secondly, you need a fairly long period when the government runs deficits, which is what the Japanese did. And so the private debt overhang becomes socialized. For reasons that I think are clear, that's risky, but actually it does seem to me pretty clear that governments can bear significantly more debt than they started off with, and that's a part of this process. This doesn't work. This way of getting out of it doesn't work if one of two things are in the way. The surplus countries, broadly defined, don't play ball. That is to say, the world out there doesn't generate the demand which allows the US and the UK, in other words, to export their way out of this difficulty. That comes to your future of the British economy thing. I'm talking about a long-term process. And secondly, it doesn't work if at some point, before we've gone through this transition, which I think of as a 20-year transition, the fiscal deficits are not brought down to a level, and the debt stock associated with it, that the markets are comfortable with bearing. In other words, if you have a major debt crisis in AAA-rated sovereign debt in UK and US bonds, and if neither of these things, if the former doesn't happen and the latter crisis does happen, we're completely screwed. Now, this is a really big point, in my view, because we can get this whole mechanism started again, and it doesn't solve the underlying problem, which is the core of my book, which is the international economic system doesn't work. And it doesn't work in very, very dangerous ways. Now, if we don't get those let-outs, if we can't export our way out of it, and if we can't sustain the fiscal position, then ineluctably there will be default, and the efficient way to default, quote unquote efficient, is through inflation. So currencies get destroyed. And that comes to the Chinese thing, the Chinese deciding they don't want to hold dollars at all, and everybody else who holds dollars deciding they don't want to hold dollars, and ditto pounds, is part of the process which brings that about. And we have a monetary meltdown.
Great.
One more round of short questions. Yeah, gentlemen, short question.
That's the big story.
How much responsibility do the politicians have in all this? My experience is they can be very naive about financial matters. Some of them still look at the economy with ideological spectacles and think this is a little local difficulty. We can get back to free markets and so on. Would a Conservative government next year, talking about big cuts? I've heard one or two Tories saying we might have to abolish the whole social security system, which is obviously rubbish, but that's the way some people are thinking. Would there be a big difference next year?
You promised me a short one. Okay. Lady here, front row.
You just described worst case scenario on currencies, and I'm wanting to know right now your projections on dollar, euro, and
currency predictions from down here. Right. Yes.
I'm not paid enough for currency predictions.
Yes. You. Louder.
Monetary crisis in Africa. What will the IMF get its money from? With countries that are that much in debt, like the UK, I wouldn't give money to the IMF now.
Gentleman behind, and then we'll come back up in a second. Louder.
Do you think accounting standards escalated the financial crisis?
Do you think accounting standards escalated the financial crisis? That's something that perhaps Will, I didn't ask you about that, Will. There's a question I wanted to ask you. You spoke about that before. Perhaps Will could take that question. Yes, the gentleman in the middle.
What did you get wrong from last time when we met here? What do you think is going to happen if it happens?
Okay. All right, what did you get wrong? And finally, one last question from someone at the back, the gentleman at the back with the black T-shirt. Last question, I'm sorry.
Why can't we let the banks go bust and then we can buy them under pennies to the pound like they buy out the assets that they lend the money to produce out of nothing for? Why can't we have a government that produces money debt-free and actually stimulates the economy by building the types of industry we need so we don't have to go to war to steal their oil? Why don't we have debt-free and
Okay, thank you. All right, stop. Now, that was 6 or 7 more questions. Chuck in again with the UK in all of this, and perhaps with a Gordon Brown in it as a small part of it. But I'm going to give you 5 minutes each to finish off. So, Martin, let's start with you, and then Will, you can have the last word.
What did I get wrong? I think the answer to that, all the things I got wrong before last October. By last October, the important things were reasonably clear, except how much it was going to cost to bail out the banks, which is a sum that keeps on rising. On the question about what's going to happen to our public finances, well, this is now, and how it's going to be managed, this is now up for grabs. Right at the moment, and nobody knows how much of this is structural and how much of it is cyclical, but the Treasury's view, also the European Commission's view, is that we have a structural fiscal deficit of 12% of GDP, which is a quarter of our public spending. There is no way you can adjust that without somebody paying a lot more or losing something. In essence, the country has turned out to be much poorer than it thought it was, and politics, real politics, after this election will be back, because we're going to have to decide how we're going to make that adjustment. The election will be a masterpiece in avoiding that question. The masterclass, I should say, in avoiding that question, as the budget was, of course. Currency predictions. I have learnt fairly little in my professional quote-unquote life, and one of them is I never predict, especially the future. But even more, I never predict currencies. But I think the safest bet here is the renminbi, which has to go up and keep on going up. Unfortunately, you can't buy it. So this is a slight problem. From its current level, from its current exalted level, the dollar doesn't look very good to me. Accounting standards. This is the mark-to-market thing on the trading book. In my view, I don't know whether all the investment banks and the investment banking arms of banks started complaining about the fact that they were forced to mark-to-market on the trading book. And that was the whole game. They wanted to be investment banks. Nobody forced them. It's a damn fool idea. Here I agree with Will. Now, if you're in an investment bank, everything is to be traded. So you market to market in the trading. Go back to being proper banks and we won't worry you in this way. But the idea that you'd have trading books and make up the prices as you go along strikes me as completely batty. So I really get very, very irritated on this one.
It takes a lot.
You asked me about the really big question. I'm sure I missed something because there were so many wonderful questions here. The future of the British economy. I think my answer to that, and because I suppose I've learnt very slowly about this, is interesting. It's not clear. Now, the final question was, why do we make banks a bust and replace them with Gosbank, essentially? Well, that's essentially what you're proposing. We have one national bank which can create money, because I feel, and we'll obviously disagree on that countries have tried that and it didn't work terribly well. But the real reason why we don't just bankrupt all the banks, we can clearly close them down, is we have made the decision, rightly or wrongly, not to default on the liabilities of the banks. I mean, the banks simply are us. They are the liabilities of the banks are the deposits, the money you have in insurance companies, the money you have in your pension fund. Well, probably some of you don't yet have a pension fund, but you might hope for one once in the future. I think it's a catastrophe that we can't allow any sort of default on any of these banks, and in fact we should have done so. We should have done so in a careful, measured way. I've written about this a lot. But letting the whole banking system implode, just simply let it wipe out, that gives you multiple Lehmans, or it gives you the 1930s, and we've been there, and we really don't want to do that again.
Will, last 5 minutes?
Well, lots of things that Martin said I agree with, and I won't go over them, except 1 or 2 points. I mean, on accounting standards, it's not only mark-to-market, although I raised that last time, and I agree with what Martin said. I mean, it's even more than that. I mean, a number of people have written, and I agree with them. I mean, I didn't know, and a lot of us didn't know, the degree to which collateralized debt obligations were being held offshore. And auditors actually were passing accounts as true and fair without actually, for my money, giving us an extent of the assets that were held offshore.
So, there's a whole story about market, there's a whole story about actually the authenticity of and thoroughness with all the things taking place. So, enough said, I think, on that. On the point about the renminbi, I always like to remind people that the renminbi is not a reserve currency. You can't buy it, you can't use it for trade between third parties. One of the things that actually constrains China's role in the international financial system. It's got a lot of our dollars, and a lot of gold, and a lot of our euros and pounds. But you can't use it. And it's a big important point about China, which is often not raised enough, that actually a country which isn't got no intentions of allowing itself to have a reserve currency cannot really be regarded as a major player, certainly in the world of finance and financial diplomacy. What thing I rather agree with Martin. I mean, things I've got wrong. By October, my mistakes were before October. I mean, and I made many of them. But I mean, since October, it's been watching the car crash play out in ways which I think we broadly got right actually when we were here in October of last year. I didn't expect the G20 to be as effective as it was actually, and I was pleased about that. And Gordon Brown's got lots of things wrong, but that was one thing that he got right. Whether politicians, I do think that there is a real problem. I mean, Vince Cable has got the confidence to talk about this. George Osborne's made one or two good speeches, but in the main, you've got 659 MPs in the House of Commons. There's a joke made about yeah, I can't make a joke. I mean, they are good. They're certainly very good at negotiations with the House of Commons fee office, but they're much less good at understanding the dynamics of domestic international finance. And that is actually very disabling. I mean, everyone understands the health service, education system, and the welfare system. They feel they can get on their hind legs and talk about that. The rights and wrongs of torture, you can talk about that. But actually, the operation of the financial system for many groups is a completely closed book, and actually much of what's gone wrong is because there are so few politicians and frankly so few journalists, leaving aside and the FT, who really do understand the financial system and its pivotal importance. And that is I don't know whether we're going to redress that intellectual failure. Yes, I think politicians were highly ideological. They all bought one of the most amazing speeches, and again, do go on the Treasury website and read it. It's Gordon Brown's speech on June the 20th, 2007 at the Mansion House, which I had enormous fun with in the dispatches I made, through dispatches films I made for Channel 4. I mean, it really is hymns of praise to light tax regulation, congratulating the City of London for its innovative genius, praising it for the financial instruments it invented, on which so much prosperity hung, asking the rest of the British economy to reproduce the kinds of things that were taking place in the city, if only it could be as entrepreneurial as the City of London. I mean, you read it, and paragraph by paragraph, the gloriousness of it, abolished, boom and bust, and what a glorious 10 years it's been. It is amazing. All that I can say is if you read speeches by other politicians at the time, they outdo even Gordon Brown in their praise of the city. Certainly David Cameron, George Osborne, they go kind of one ratchet higher in the effusive praise of the City of London. And people did buy, the political class and politicians of all parties did buy the story that the financial services sector was not just our future, but actually in it was some unique innovativeness and entrepreneurialism which actually the rest of the country could do well to reproduce. We know that story isn't true now. So where do we go in the next decade, this country? Martin says, interesting. I don't think we'll recover 2008 levels of GDP until 2012. 2007 house prices, the peak until 2015. We face... God,
you're an optimist. 2020 is my view. The house prices. House prices, ridiculous.
All the engines of growth of the decade of 2007 are busted, are bust.
And we are balance sheet constrained. And that was the question that people how are we going to get around these balance sheet constraints? Well, the answer is we're going to have to, in my view, Bok's very clever, and I think build some new banking capacity. One of the answers to the dilemma of how to get through the next decade is actually, let's build some new banks, let's build some new banking capacity, so that at least we can get sufficient credit growth to finance some kind of recovery. I don't think there's sufficient bank capacity in the United Kingdom at the moment, and the bank capacity that we have is very risk-averse, usurious, short-termist, and all the things I criticised the banking system for when I wrote The State we're in the mid-1990s are up there in lights now. And I think the opportunity confronts us as a national community to really think through how we do banking, how we do finance, which is the necessary, if insufficient, condition for sustained growth. And I don't think that we have a banking system that's fit for purpose, and we need that debate out in the open. And really, the fact that there's one speech from George Osborne and 3 from Vince Cable, and we're sticking to, and we're holding on to nurse for fear of something worse is not good enough. But what will drive growth in the next decade will be, I think, over and above it will be, let's hope, some really good innovation. And actually, innovation is a great kind of wealth generator. And in the next decades, 2-3 decades, many of these general purpose technologies, like the internet, like internal combustion engine, that have fired up growth kind of over the last many hundreds of years. There's an intensification of their introduction. And actually, we may find, if we can just build a sufficient credit growth, relieve, why should it be that the public sector has to only have 60% debt to GDP ratio? Couldn't it stick at 80 and just gradually get down to 60? Why do you have to say that getting down to 60 by 2015 or these artificial targets seems to be kind of completely inappropriate? It seems to me one should put the growth target first, the development objectives first, the employment objectives first, and then try to see that the debt that follows from it is more or less livable with, rather than putting the financial criteria first. So for me, we innovate our way out of this. We try to lift the balance sheet constraints by reinventing our banking system. And yes, we have to have export growth, as Martin has said. But it's going to be a very, very difficult and tough decade.
Well, I mean, they can't walk on water. They can't single-handedly restore the British economy. But they came twice to the LSE, and we need to thank them greatly for that.